Gold just punched through $4,600 an ounce. Silver's back above $70. And if you think this rally is about safe haven fear, you're only seeing half the picture. Because here's what almost nobody's talking about. This move didn't start with a war headline or a shock inflation number. It started with a bond market maneuver most investors scroll right past. The US Treasury quietly stepping in to manage its own borrowing costs. And when the people running the country's finances start intervening in their own debt market, gold and silver listen a lot closer than most of us do. So today, I'm breaking down exactly what happened, why it's got both metals moving together, what the actual mechanics behind this rally are, and what it means for where they go from here. Stick around to the end, because I'm also going to walk you through the exact levels I'm watching heading into next week. Let's get right into it. Gold closed the week near $4,600 an ounce, its best level in about 3 months, capping off a roughly 5% weekly gain. Silver rode right along with it, trading above $69, up more than 2% on the day. Now, a 5% weekly move in gold is not a small thing. To put that in perspective, gold typically moves maybe 0.5% to 1% on an average day, and a really volatile week might see it swing 2 or 3% total. 5% in 5 trading days tells you real money was moving, not just algorithms nudging prices around on light volume. Let's rewind and actually walk through how the week unfolded, because the sequencing here matters a lot for understanding what's really going on. Early in the week, gold was actually fairly range-bound. Nothing dramatic. Yields on the long end of the Treasury curve, we're talking the 10-year and 30-year notes, had been climbing for weeks, driven by a combination of heavy government deficit spending and a wave of debt issuance tied to the AI infrastructure build-out that's been sweeping through corporate America. Companies borrowing huge amounts to fund data centers and chip capacity were competing with the government for the same pool of lending capital, and that competition was pushing yields higher. By midweek, those yields were creeping towards some of their highest levels in nearly 2 years. And normally, that kind of move, yields grinding higher, is actually a headwind for gold, not a tailwind. Gold doesn't pay any interest or dividend, so when bonds start offering more attractive yields, some money naturally rotates out of gold and into bonds. That's Econ 101 for the gold market. But then something shifted. Midweek, the Treasury Department announced it was expanding its buyback program for longer-dated government bonds. In plain English, the government said it was going to start buying back some of its own outstanding debt at the long end of the curve, specifically to relieve some of that upward pressure on yields. And this wasn't a small technical tweak. Reports indicated they were looking to at least double the size of these buybacks going forward. The market's initial reaction was actually to push yields down sharply, since a big buyer stepping into the bond market naturally pushes bond prices up and yields down. Gold caught a bid almost immediately. But here's the part that's easy to miss if you're just glancing at headlines. Yields didn't just stay down. They actually snapped back up again within a day or two, testing back toward those recent highs, as the market essentially called the Treasury's bluff and asked whether this buyback program was really big enough to structurally change the picture. That, back and forth, yields dropping on the announcement, then rebounding as skepticism crept back in, is exactly the kind of volatility that tends to be great for gold. Uncertainty about whether policymakers can actually control the bond market is, historically, rocket fuel for a safe haven asset. Then Friday arrived, and gold broke out decisively above that $4,600 level as the dollar slipped further, and Treasury Secretary Scott Bessent signaled there could be more buybacks coming if borrowing costs stayed elevated. That comment mattered. It told the market this wasn't a one-time intervention. It was potentially the start of an ongoing policy stance. Silver, meanwhile, had its own story running in parallel. It had been lagging gold slightly through the middle of the week, which is actually pretty normal. Silver tends to be the more volatile, higher beta metal, and it often needs a little extra conviction from buyers before it really participates in a move. But on that final session, silver didn't just keep pace with gold, it actually outperformed it on a percentage basis, jumping more than 2% in a single day. That's worth flagging early because we're going to come back to exactly why that matters in a few minutes when we talk about the gold-silver ratio. So if you're keeping score at home, here's the simplified version of the week. Rising yields created pressure early on. A Treasury intervention flipped the narrative midweek. Skepticism about whether that intervention would actually hold created volatility. And by Friday, a weaker dollar plus more dovish signals from the Treasury pushed both metals to their best levels in months. That's a big move for both metals in a short window. And it didn't happen because of some dramatic geopolitical shock. It happened because of what the US Treasury Department just did with its own debt. So why does a bond buyback program matter so much to gold and silver investors? Let's break down the actual chain of logic here, because I don't want this to just be the government did a thing and gold went up. I want you to actually understand the mechanism. Here's the trigger, restated clearly. The Treasury announced it's expanding its buyback program for longer-dated government bonds, essentially stepping into the market to buy back its own debt and put downward pressure on yields. Treasury Secretary Scott Bessent has signaled there could be more of this coming if borrowing costs stay elevated. On the surface, that sounds like a technical, boring bond market maneuver that only bond traders should care about. But investors read it very differently, and here's why. When a government has to actively intervene in the market for its own debt to keep borrowing costs manageable, that's not a sign of strength. It's a signal about how strained the fiscal picture has become. Think about it from first principles. A healthy, fiscally sound borrower doesn't need to step into the market and buy back its own bonds to keep yields under control. That's something you do when the market is starting to demand a higher and higher premium to keep lending you money, and you need to intervene before that premium spirals. And gold, historically, tends to love that kind of signal. Gold isn't just a hedge against inflation. It's fundamentally a hedge against confidence in fiat currency and government finances more broadly. Every time investors get a fresh reminder that a government is leaning on unconventional tools to manage its own debt, some portion of the market rotates toward an asset that exists entirely outside that system. That's gold's core value proposition, and it's exactly what played out this week. There's also a subtler angle here worth mentioning. This kind of intervention creates a bit of a credibility question. If the Treasury has to keep expanding these buybacks every few months just to hold yields at a manageable level, that raises the question of what happens when buybacks alone aren't enough. Does the Fed eventually get pulled in to help manage the situation? Does inflation tolerance quietly increase because inflating away some of the debt burden becomes politically easier than the alternative? None of these questions have clean answers right now, but the market doesn't need clean answers to start pricing in the uncertainty. It just needs the question to be on the table. And this week, that question moved from a background worry to a front page story. Let's get into the actual mechanics, because I think this is the part that separates people who just watch the headlines from people who actually understand what's driving their portfolio. Treasury buybacks reduce the supply of long-dated bonds available in the open market. Basic supply and demand. When there's less of something available to buy and demand doesn't fall by the same amount, the price of that something tends to rise. Bond prices and bond yields move in opposite directions. So when bond prices rise, because supply just got smaller, yields fall. Now, why does a falling yield help gold? Because gold is what's called a non-yielding asset. It doesn't pay you interest. It doesn't pay a dividend. The only way you make money holding gold is if the price itself goes up. That means gold is constantly competing against yield-bearing alternatives like treasury bonds for a spot in investor portfolios. When treasury yields are high, gold has to work harder to justify itself, because why would you hold an asset paying you nothing when you could hold a government bond paying you 5%? But when yields fall, that opportunity cost shrinks, and gold becomes relatively more attractive. That's the direct mechanical link between this week's buyback news and the move in gold prices. But here's the more important point, and it's the one I really want you to walk away with. Not all falling yields are created equal. If yields fall because inflation is cooling and the economy is slowing in an orderly way, that's actually a pretty normal, healthy backdrop, and gold's reaction tends to be more muted. But when yields fall because of a policy intervention, because the government had to step in and buy its own debt to keep a lid on borrowing costs, that reads as a red flag, not good news. It signals fragility rather than health. And markets, especially the gold market, are very good at telling the difference between yields falling for good reasons versus yields falling because policymakers had no other choice. Layer on top of that the dollar story. The US dollar slipped over the course of the week, and a softer dollar makes gold cheaper for buyers using other currencies. Think central banks in Asia, private buyers in the Middle East, institutional funds in Europe. When the dollar weakens, gold effectively goes on sale for a huge portion of the world's buyers, which adds real mechanical demand on top of the sentiment-driven demand we already talked about. So you've got two forces reinforcing each other this week. Falling real and nominal yields making gold more attractive on a relative basis, and a weaker dollar making it more attractive on an absolute purchasing power basis. And then there's the backdrop that ties all of this together. U.S. federal debt has now pushed past $40 trillion. Let that number sit for a second. That's not a talking point from one side of the political spectrum. It's simply where the math currently stands, and it's been climbing steadily for years, regardless of which party has controlled Washington. That number sits in the background of almost every gold rally we've seen over the past 2 years. It's the slow-moving structural story underneath all the day-to-day noise. Every time there's a fresh headline about debt issuance, deficit spending, or, like this week, a Treasury intervention to manage borrowing costs, it's really just another data point in that much longer story. And that's part of why I don't think this week's move should be treated as an isolated one-off. It's a symptom of something much bigger that's been building for years. One more layer worth mentioning here, because I think it helps explain why the move was so broad-based rather than just a gold story. Central banks around the world have been steady, consistent buyers of gold for years now, as part of a broader effort to diversify their reserves away from heavy concentration in dollar-denominated assets. That's not a new development from this week, but it's an important piece of context. It means there's a persistent bid underneath the gold market that doesn't depend on any single week's headlines. When retail and institutional investors pile in on top of that already existing central bank demand, you get moves like the one we saw this week. Fast, broad, and across both metals rather than isolated to just one. Let's zoom in specifically on gold's price action. Gold's trading in the mid-4600s, and depending on which feed you're watching, that's within striking distance of its all-time high near $5,600, which was set back in January of this year. I want to point out something about the character of this move because it tells you something about who's actually buying. The move this week wasn't a spike and fade, meaning it didn't shoot up in one session and then give most of it back. It built steadily over several sessions, with dips getting bought rather than sold into. That pattern tends to reflect real positioning from institutions and serious investors, rather than just a knee-jerk reaction from short-term traders chasing a headline. If you look at the broader chart, gold has been on an extraordinary run over the past couple of years. It crossed the $3,000 threshold back in March of last year, and by January of this year it had already touched that all-time high above $5,500. That means, even after this week's 5% gain, gold is still trading below its record. But it's clearly knocking on the door again, and this latest push has real macro fuel behind it rather than just being a technical retest of old highs. For context on just how significant this multi-year run has been, over the trailing 5 years, gold has dramatically outpaced even the stock market, delivering returns well over 100%, more than double what a broad index fund tracking something like the S&P 500 has returned over the same stretch. That's an important reminder for anyone who thinks of gold as a boring, sleepy asset that just sits there. This has been one of the more dynamic trades in the entire market over the past several years. Now let's talk silver, because I think this is actually the more interesting story out of the two metals this week. Silver's story is just as important as gold's, arguably more so, because of how it behaved relative to gold. It didn't just tag along for the ride. It actually outperformed gold on a percentage basis on that final session. That's compressed the gold-silver ratio down to around 65 to 66. For anyone newer to this space, the gold-silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. When that ratio is high, it means silver is cheap relative to gold, historically speaking. When it compresses, meaning the number gets smaller, it means silver is catching up to or outpacing gold's gains. A ratio compressing from a higher level down toward the mid-60s means silver is keeping pace with gold rather than lagging behind it, which is actually the more unusual pattern. Silver often lags early in a precious metals rally, and then plays catch-up later, sometimes violently. Seeing it keep a pace this early is a signal worth paying attention to. When silver participates like this, it usually tells you speculative and industrial demand are both showing up at the same time. And silver's industrial demand story really is distinct from gold's. Roughly half of all silver demand today comes from industrial applications. Electronics, solar panel manufacturing, and electric vehicle production are the big ones. Gold, by contrast, is overwhelmingly a monetary and jewelry asset with comparatively little industrial pull on it. That industrial dimension means silver's price isn't purely a function of safe haven sentiment the way gold's move often is. If silver is rallying alongside gold, it suggests buyers aren't just seeking shelter from fiscal uncertainty. They may also be betting on continued strength in the industries that consume silver directly. And there's a structural supply story layered underneath all of this too. The silver market has been running in a supply deficit for several years now, meaning the world has been consuming more silver than mines have been producing, which has been steadily eating into above-ground stockpiles. That's a slow-building, multi-year dynamic that doesn't get resolved by any single week's headlines, but it does mean silver has a firmer structural floor underneath it than a lot of people realize. Silver's still trading meaningfully below its own all-time high, which sits above $120 an ounce, set back in January. So even with this week's strength, there's real room left if this rally has legs. Let's talk about where this could go from here, because I don't want this video to just be a recap. I want you walking away with a framework for thinking about the next move. Scenario 1, the bullish path. If the dollar keeps sliding and yields stay capped by these Treasury buybacks, gold has real room to keep grinding higher toward that all-time high zone above $5,500. Silver, given its recent outperformance and the structural supply deficit underneath it, could actually lead that move rather than following it, especially if the gold-silver ratio keeps compressing. Scenario 2, more of a choppy sideways path. If yields keep whipsawing the way they did this week, dropping on Treasury intervention, then snapping back up as the market tests the credibility of that intervention, gold and silver could enter a more volatile, range-bound stretch where big up days get partially given back on the days when yields rebound. This is honestly probably the most likely near-term scenario because we haven't yet seen evidence that this buyback program is actually large enough to durably hold yields down over a period of weeks rather than days. Scenario 3, the bearish path, at least in the short term. If yields snap back up quickly and durably, which they've already done once this week after an initial dip, that could take some of the wind out of the rally. This would likely happen if incoming economic data suggests inflation is running hotter than expected, which would make it harder for the Fed to justify letting yields fall, even with the Treasury's intervention working in the background. In that scenario, don't be surprised to see gold pull back toward the $4,500 area, and silver give back some of its recent outperformance. I'll say this clearly. None of these scenarios cancel out the longer-term structural story we talked about. The $40 trillion in debt, the ongoing central bank buying, the ongoing tension between fiscal and monetary policy. Those are multi-month, multi-year dynamics. So what we're talking about here with these three scenarios is really about the next 1 to 2 weeks of price action layered on top of that bigger picture. So heading into the new week, here's exactly what I'm keeping my eye on, and what you should be watching too if you want to stay ahead of the next move rather than reacting to it after the fact. First, Treasury yields, especially the 10-year and 30-year. These have been the single biggest driver behind this entire move, more than any single headline about gold or silver directly. If you see the 10-year pushing back up toward those recent highs near the top of its range, that's a signal the market is losing confidence in the Treasury's ability to keep yields contained. That tends to be a headwind for the metals in the short term. If yields stay capped or keep drifting lower, that's supportive. Second, any follow-up comments from Treasury Secretary Bessent about additional buybacks. He's already signaled more could be coming, and the market will be listening very closely for any specifics. Size, timing, which parts of the curve they're targeting. More detail and bigger numbers would likely be read as bullish for gold and silver. Vague or smaller than expected follow-through could disappoint the market and take some steam out of this rally. Third, keep an eye on the dollar index. It's been sliding, and that's been a real tailwind for gold priced in dollars. If the dollar finds a floor and starts to stabilize or bounce, that removes one of the legs supporting this week's move. And fourth, and I think this one's underappreciated, watch for any commentary from Fed officials pushing back on what the Treasury is doing. There's a real tension building between an administration trying to manage its own borrowing costs and a central bank that may want to keep financial conditions tighter to fight inflation. If that tension becomes more public and more contentious, that kind of policy friction has historically been very supportive for gold because it signals confusion and disagreement at the highest levels of economic policymaking, and markets hate that kind of uncertainty, except gold, which tends to thrive on it. Both of these, Treasury yields and follow-up buyback commentary, are the actual drivers behind this move, more than any headline you'll see about gold itself. If you only watch the gold price and ignore what's happening in the bond market, you're going to be perpetually surprised by moves like the one we just saw this week. If this kind of breakdown helps you actually understand what's moving your portfolio, not just what happened, but why it happened and what to watch next, hit subscribe, because tomorrow's session could bring a very different setup, and I'll have that covered before the bell. And if you found this useful, drop a comment letting me know which scenario you think plays out next week. Bullish breakout, choppy consolidation, or pullback. I read every one of them, and it genuinely shapes what I cover next. But here's the question nobody's asking yet. What happens to this rally if the Fed and the Treasury start pulling in opposite directions? One trying to hold yields down, the other trying to keep financial conditions tight enough to fight inflation? That tension is exactly what we're digging into next, along with the full bull, base, and bear case for gold and silver over the coming months. That's next.